This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I want to give a gentle reminder. Well, perhaps it's going to be harsh by the time I'm finished. Let's talk surefire predictions, otherwise known as 100% complete fucking bullshit. Now, for those of you academics out there, for those few quant traders, those brilliant minds that want to use prediction in a very mathematical sense, in a very edge sense, you're excused. I get it. But for those of you that think you can predict tomorrow, you can predict next week, you can predict all of 2016, you are sadly mistaken. You know this deep down in your gut. You know you can't. But you want to believe. You want to be foolish. Well, of course, you will get exactly what you want, to paraphrase Ed Seykota. If you want to believe in something that cannot happen, you will get exactly what can happen, which is nothing. A nice little piece of writing about predictions, courtesy of Seth Godin. I'm betting on the following happening in 2016. An event will happen that will surprise, confound, and ultimately bore the pundits. Out of the corner of your eye, you'll notice something new that will delight you. You'll be criticized for work you shipped, even though it wasn't made for the person who didn't like it. Something obvious will become obvious. A pop culture emergency will become the thing that everyone is talking about, distracting us from the actual important work at hand. You'll gain new leverage and the ability to make even more of a difference. We'll waste more than 1 billion hours staring at screens. That's in total, but for some people, it might feel like an individual number. That thing that everyone was afraid of won't come to pass. Some people will gain temporary power by ostracizing the other, amplifying our fears, and racing to the bottom. And the long-term trend toward connection, dignity, and possibility will continue, slowly. Opportunities will be missed, lessons will be learned. You'll say or write something that will shine a light, open a door, and make a connection. Nothing will be as perfect as we imagined it. Many things will be better than that, though. Leaps will be taken. You will exceed expectations. The project you've been working on will begin to pay off in unexpected ways if you're open to seeing them. You will start something, and guess what? You will quit something. That expensive habit that you don't even enjoy that much will continue to be very expensive. We'll forget some hard lessons, but we'll also learn some new ones. That's a pretty safe list, as Mr. Godin notes. And as he concludes, because of course, this list always happens. So unless you have this keen statistical understanding, and you're going to use prediction in that fine mathematical sense, stay away from it. You're only going to go down a wrong path. But guess what? Many people that want to go down the wrong path, that's the path they want to go down. The wrong path. They really don't want to go down the right path. They want the illusion. They want the crystal ball. They want the excitement. They want the delusion. They want the insanity. They want it all. They don't want normality. They don't want to succeed. They don't want to win even. Let me take you in a concrete direction for a moment, away from the big picture philosophical. Market timing. Hell, I don't even know what market timing means exactly. There's so many damn definitions of this stuff. I know what trend following is. I've written about trend following across 5 books. I've put it in this podcast. It's in a film. We can look at the track records. We know what trend following systems are. We know how they work. We know what the evidence is. Market timing? Less defined. I'm going to read a brief excerpt from Institutional Investor. The title, Market Timing is Back in the Hunt for Investors. Market timing, considered by many an investing sin, can be a virtue if employed modestly using a combination of contrarian and trend-following strategies. The authors of this piece are all very smart, wealthy guys. Led by Cliff Asness at AQR, the other 2 guys from AQR as well. For 15 years, we have attributed the following quote to the late economist Paul Samuelson, though admittedly, we can't find a trace of it now. We remember him saying near the height of the technology bubble of the 1999 to 2000 period, when stock prices were at astronomical highs, something along the lines of, quote, market timing is an investing sin, and for once, I recommend that you sin a little, end quote. He meant, if he ever actually said it, that things were so obviously wrong at that time that even a lifelong buy and holder would recommend some judicious selling. In attempting to confirm this quote, one of us checked in with Vanguard Group founder Jack Bogle, who could not help us with the attribution, but admitted to lightening up on stocks himself somewhere near that late 1990s NASDAQ high. We can confirm that he did indeed make very prescient and public forecasts of lower than normal expected long-term stock returns at the time. If market timing is a sin, then there are times when even the saints can be tempted into sinning a little. We're going to argue that market timing isn't really a sin, except as for so many things, if done to excess. But the results and logic behind the 2 simple strategies that govern so much of the investing world, basic value or contrarian investing and basic momentum or trend following investing, imply that when it comes to market timing, one should indeed sin a little and do so as a matter of course, not just at extremes. Today's high stock prices, and for that matter low bond yields and low expected future returns, at least in our opinion, naturally bring the timing discussion back to the forefront, leading many investors to wonder if they should get out now. The answer to this question is almost certainly not. Getting out now is a very extreme action, yet oddly often how people think about market timing, an approach to timing that we will soon label binary, immodest, and asymmetric. If, on the other hand, investors wonder whether they should own somewhat fewer stocks and bonds than usual right now, well, that's a much harder and much more interesting question. Overall, for those who think market timing is infeasible, we give hope. At the other extreme, some observers oversell market timing as easy and reliable. It ain't. I am not attempting to have a debate with Cliff Asness today. That's not my objective. Hopefully I can have him on the show in the not too distant future. One of his associates, Lasse Peterson, also at AQR, has appeared on this show. But there's a few points that I want to make. Go read the complete article. The complete article is making a point that I don't make. It's making a point that I don't talk about in my world. But there are some interesting quick notes that I see, the reason that I just read those few excerpts, and I want to talk about those today. Number 1, Paul Samuelson was an owner of Commodities Corporation. Commodities Corporation essentially backed almost all of the guys that were listed in the Market Wizards books, the trend-following traders. Commodities Corporation was not just an incubator for traders and random trading strategies. They were the incubator for trend-following traders. They were it. So even though Paul Samuelson has the academic resume that every academic wants. All the accolades, all the awards. And he really didn't believe that trend following was possible. Trend following as defined, clearly across my work. He made an absolute fortune off trend following. So if I see any comment by Paul Samuelson, especially if it has to do with market timing, I look at the public statements, I look at the quotes, and then I say, what was the reality on the ground? The reality on the ground, he was an owner of Commodities Corporation, a firm that made a bloody fortune of technical trend following trading. Of course, how Samuelson is talked about in this particular piece and how market timing is talked about is different than trend following. And that's my second major point that I want to address. As I just read, the article postulates, are stocks too high? No one knows that answer until some point into the future. And since we can't walk into the future, or we can't transport there yet, we don't know what will happen to those stock prices. But to dig a little deeper on this issue, and to try and address some of this market timing jargon confusion, especially contrasted with something like trend following, which is a known quantity. Trend following is not practiced over one market. You're not going to be a one market trend following trader. It doesn't work that way. You need a portfolio of markets that you can follow. You have a tracking portfolio. In that tracking portfolio might be gold, might be soybeans, might be oil, might be assorted stocks. Those are all markets. Who the hell cares what the name is? But you can't pick one and try and time one. That's where so many of these, quote, predictive market technicians, they fall off the wagon. They pick their one market and they say, well, if we use this particular squiggly line, this particular chart pattern, this particular moving average, we know what's going to happen in the future. No, you don't. You've only got one market. So if you make that bet and you're wrong, it goes up, you get stopped out. It goes up, you get stopped out. Whatever the scenario might be that whipsaws you to death. And speaking of whipsaws, a little whipsaw inspiration for the new year coming at the end of this podcast. You just can't do it on one market alone. You need the other markets to pay for the losses, which will end up being over 50% of your trades, over 60% of your trades. As I started this podcast ripping prediction, here's where it circles back. You have the diverse portfolio because you don't know what's going to hit. You have oil in your portfolio in early 2014, not because you think it's going to be one of the greatest shorts in the history of the markets. You have it there because you need diversity, because you don't know which market's going to move next. So you can't be a market timer on oil alone. It's idiotic. If the market doesn't go your way, if you're not right, you lose money. How do you balance that out? Well, you can't. Hell, this isn't Michael Covel's opinion. This is freaking math. You need diversification. Market timing on one market alone, and I believe that Cliff Asness and I share this opinion, market timing on one market alone, well, that's just going to end the way that you really know it's going to end. Not well. I'm sure people notice on this podcast, I will weave in as much technical discussion as I will the psychological discussion. So for those people out there that want to believe in one market trend following, one market timing, one of my prior guests Daniel Kahneman, the Nobel Prize winner. He has some great answers. I implore you to go back into my podcast and listen to many of my psych guests, as I will call them. The Daniel Kahnemans, the Vernon Smiths, the Barry Schwartz, the Hersh Sheffrins, the Michael Mobisons, the Meyer Statmans. To add to those great psychological foundations that I've presented across this podcast, and to tie back into this bloody, crazy market timing concept that so many people have, 3 excerpts that I would like to add from Daniel Kahneman. First, the trouble with confidence.
Society rewards overconfidence. We want our leaders to be overconfident. If they told us the truth about the uncertainty, we would discard them in favor of other leaders who sort of give an impression that they know what they're doing. We want overconfidence. We support it. We sustain it. And there is an awful lot of it. Most of what we read in the paper is overconfidence. Sometimes it's catastrophic. Just about every war that you see, I think that's a general rule, there are optimists among the generals, and there are optimists on both sides. And that is true for a lot of litigation as well. So a lot of conflict is fed by overconfidence. There is an interesting story here of 2 biases that work in opposite directions. So one familiar, you can call it bias, but is what we call loss aversion. People put a lot more weight on negative events than on positive events, on losses than on gains. So that's one principle that, if people are to gamble money on the toss of a coin, and they stand to lose $100, they will demand more than $200 to accept the gamble, which is in some ways ridiculously risk averse. So people are loss averse. On the other hand, they're optimistic. And so many of the decisions that people make, especially in starting new businesses, that is where it's been studied most extensively. People think they will succeed. They open a restaurant because they think they will succeed. But in fact, less than a third of small businesses survive for 5 years. So clearly, overconfidence is rife. And overconfidence and loss aversion seem to be acting in opposite directions. You have to distinguish the perspective of the individual from the perspective of society. I think for society, it is probably very good that we have a lot of optimistic entrepreneurs, who think they will succeed, although most of them fail. And most of them really do not know the odds. It is not true that they know the odds and they take the risks willingly. Many of them, most of them probably, do not know the odds. From the point of view of the individuals, it is not always good to be optimistic. For example, I have no interest whatsoever in my financial advisor being an optimist. I don't care for that. For an entrepreneur, it may be a good thing to be an optimist because it will make him or her persevere more.
Again from Daniel Kahneman. Why we make bad decisions about money and what we can do about it.
People are not fully rational, and they make many choices that if they reflected upon them, they would do differently. There's no question about that. And we have a fair understanding, actually, of what is happening. At least at the individual level, my sense is that we have explored a lot of what is happening. I wouldn't say there's going to be no further progress, but we've explored a lot. The major tendencies? Well, the major tendencies to people tend to frame things very narrowly. They take a narrow view of decision-making. They look at the problem at hand, and they deal with it as if it were the only problem. Very frequently, it's a better idea to look at problems as they will recur throughout your life, and then you look at the policy that you ought to adopt for a class of problems. Difficult to do would be a better thing. People frame things narrowly in the sense, for example, that they will save and borrow at the same time instead of somehow treating their whole portfolio of assets as one thing. If people were able to take a broader view, they would in general make better decisions. So that is certainly one of the weaknesses of human decision making. We call it narrow framing. Mental accounting, is a big deal. This is the way that we live. So we keep our money in different mental accounts for which we have different rules. So people will, of course, they spend their spending money. But then there is a hierarchy of the accounts that they will touch. They will spend money that they've stored for vacation quite often before they will spend whatever they're thinking of as savings for their children's education. So those are mental accounts for which people have different rules. More foolishly, this is pretty sensible because mental accounting is a tool of self-control. But more foolishly, investors tend to view each stock that they buy as a mental account, and they want to sell it when it is a winner. And so they tend to sell their winners and to hang on to their losers in their portfolio. And that turns out to make them substantially poorer than if they had done things differently. You need to be numerate for certain kinds of decisions. So numerate people have a significant advantage over those who are not. Understanding compound interest makes a huge difference whether you're a credit card borrower or somebody with saving. People have a very hazy idea of compound interest, and it's very detrimental. So I would say that, first of all, you need to be numerate, but many people are. Then you need to frame things broadly. I mean, that's it frequently goes with numeracy, but it's not quite the same thing. And then, by taking the broad view, it is very important not to have overly strong emotional reactions to events. And what I mean by that is that most of us tend to respond to gains and to losses, to changes that happen in our life. Actually, you're better off if you frame things broadly and you think of, you win a few, you lose a few, and you have very limited emotional response to small gains and to small losses.
One more from Daniel Kahneman that really hits home. Moving to California won't make you happy.
If we talk about subjective well-being, there are two really different ways of looking at it. And one is to look at people's mood or state of mind as they live their life. And the other is to measure their satisfaction or their emotional reaction when they think about their life. We know now that these two are really quite different. They're sensitive to different factors. So the things that make you satisfied do not necessarily make you happy. People have very little idea of, how their tastes will change. They're susceptible, first of all, to what we call a focusing illusion. And that makes it virtually impossible to think straight about your own life. Nothing is quite as important as you think it is while you're thinking about it. So the mere act of thinking about something makes it more important than it's going to be. So you're thinking, how much happier would I be living in California? And, you think, oh, you'd be a lot happier. Well, no, you won't be a lot happier. How much happier would I be, if my income increased by 30%? You think a lot. No, it wouldn't. So just about everything that people think about, they exaggerate its importance. If you look at life satisfaction, at what makes people satisfied with their lives, most of what we know, it has a lot to do with people's goals. When we ask people how important money is to them when they're 18, and we look at their income at age 45, we find that the people who said at age 18 that money didn't matter to them very much, at age 45, money doesn't matter to them very much. So the correlation between their income and their satisfaction with life is really very low. The people who said that money is very important to them, those who made a lot of money are really quite satisfied with their lives, and those who didn't make a lot of money are really quite miserable.
Trading and psychology are magically tied together. Trading and the mind tied together. Your emotions and trying to make money tied together. You can't separate the two. You want to be a quant and you don't want to have to think about the mind. You think you've got it all figured out and you just want to code it and all you want are the quote rules and that's all you need and you don't need to think about what Daniel Kahneman has to say. Guaranteed you will fail. No ifs, ands, or buts about it. You will not make it. Your money will drip, 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 a bloody drip out of your pocket. It will be gone. But once you see this interconnected picture, this interconnected world of the system, trading a diversified portfolio, and your mind, thinking about issues that Daniel Kahneman would bring up, like prospect theory, loss aversion, the disposition effect. Once you see the interconnected, how they dovetail together, that's the big aha moment. I've mentioned it many times on this podcast. One of my mentors, one of the people that helped me to see this connection, is a trader, Ed Seykota. Ed has always been very good at blending together the systems and the psychology. And what's so damn fun about Ed is how he does it. Definitely go back and listen to both interviews with Ed Seykota on this podcast. But it's really simple if you're willing to accept the simplicity. In fact, Ed sings about it right here.
Hi, I'm Ed Seykota. In response to numerous requests over the years to reveal the inner workings of my trend trading system, I hereby take great pleasure in presenting its essential elements for your financial edification. Joining me today are several members from the Northern Nevada Bluegrass Association. We gather to play benefits for local area hospitals. If you are currently in a clinic as a recovering marketaholic, or even if you have a mild case of marketitis, this tune might put you on the road to recovery. In any event, pull up a chair, lean into your monitor, and lend us an ear. We hope that you enjoy the show. You get a whipping, I get a saw, honey. You get a whipping, I get a saw, babe. You get a whipping, I get a saw. One good trend pays for them all, honey trader, baby mine. Now what do we do when we catch a trend, honey? What do we do when we catch a trend, babe? Oh, what do we do when we catch a trend? We ride that trend right to the end, honey trader, baby mine. So you get a whipping, I get a saw, honey. You get a whipping, I get a saw, babe. You get a whipping, I get a saw. One good trend pays for them all, honey trader, baby mine.
Well, what do we do when we show a loss, honey? What do we do when we show a loss, babe? What do we do when we show a loss? We give that daggone loss a toss, honey, baby mine. Well, you get a whipping, I'll get a saw, honey. You get a whipping, I'll get a saw, babe. You get a whipping, I'll get a saw. One good trend pays for them all, honey trader, baby mine.
Is right, honey? How do we know when the risk is right, babe? Well, how do we know when the risk is right? We make a lot of money and we sleep at night, honey, baby mine. So
you get a whipping, I'll get a saw, honey. You get a whipping, I'll get a saw, babe. You get a whipping, I'll get a saw. One good trend pays for them all, honey trader, baby.
what do we do when the price breaks through, honey? What do we do when the price breaks through, baby? What do we do when the price breaks through? Our saucer in, so there's nothing to do, honey, baby mine. So you get a whip and I'll get a saw, honey. You get a whip and I'll get a saw, baby. You get a whip and I'll get a saw. One good trend pays for them all, honey trader, baby mine. What do you do when the drawdown comes, honey? What do you do when it gets real big, babe? What do we do when it's even bigger? We stick to the plan and pull the trigger, honey trader, baby mine. Well, you get a whip and I'll get a saw, honey. You get a whip and I'll get a saw, baby. You get a whip and I'll get a saw. One good trend pays for them all, honey trader, baby mine. What do we do with a hot news flash, honey? What do we do with a hot news flash, baby? What do we do with a hot news flash? We stash that flash right in the trash, honey trader, baby mine. So you get a whip and I'll get a saw, honey. You get a whip and I'll get a saw, baby. You get a whip and I'll get a saw. One good trend pays for them all, honey trader, baby mine. Good trend pays for them all, honey trader, baby mine.
I seriously doubt that anybody else will ever dream up and play such a song. If you want a great 2016 prediction, here's mine. The vast majority of people will never listen to that song, and if they do listen to it, they won't understand it, and if they do understand it, they sure as hell won't follow any of it. That, ladies and gentlemen, is a prediction you can bank on. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.